Peer-to-peer lending sounds like the perfect passive income play. You lend money, collect interest, and watch steady returns roll in. No stock market stress, no complicated strategies. But here's the part most platforms don't tell you. For the average investor, peer-to-peer lending quietly underperforms and often fails altogether. Defaults rise when the economy slows. Liquidity disappears when you need your money most. And fees eat away at returns you thought were guaranteed. What looks like a safe, predictable investment on paper often turns into a slow drain on capital in real life. And that's exactly why most investors walk away disappointed. Today, we will talk about why peer-to-peer lending fails most investors. So before we start, make sure to hit the like button and subscribe to my channel. How peer-to-peer lending actually works. At its core, P2P lending allows individuals to lend money directly to borrowers through an online platform. Borrowers may be consumers consolidating debt, small businesses seeking working capital, or individuals with limited access to traditional banks. Investors fund portions of these loans and earn interest as borrowers repay. The platform handles borrower screening, loan servicing, payment collection, and distribution of returns, while taking a cut at every step. This structure creates an illusion of professionalism and safety, but it also introduces layers of hidden risk most investors fail to understand. Misleading promise of high returns. P2P platforms frequently advertise average annual returns in the range of 7% to 12%, sometimes even higher. What they rarely emphasize is that these figures are gross returns before defaults, late payments, platform fees, reinvestment delays, and taxes. The actual net return for many investors, especially after a full economic cycle, is far lower. In practice, once losses are realized, many investors barely outperform inflation, and some even experience negative real returns. Default risk is not an exception, it is the core risk. The fundamental flaw in P2P lending is that it exposes individual investors to unsecured consumer credit risk. Most borrowers on these platforms are there because traditional lenders rejected them or charged higher rates. This means default risk is not a rare event, it is expected. While platforms assign risk grades and probabilities, these models are based on historical data that often fails under stress. During economic downturns, default rates can spike far beyond projections, quickly erasing years of interest income. Risk models break down in real-world conditions. P2P lending algorithms are built using backward-looking data from relatively stable economic periods. When conditions change, job losses rise, interest rates increase, or inflation squeezes household budgets, borrower behavior shifts dramatically. Risk models that looked accurate on spreadsheets fail in real life. Many investors discover too late that diversification across hundreds of risky loans does not eliminate systemic risk when defaults rise across the entire platform simultaneously. Fees quietly drain returns. P2P platforms make money whether investors succeed or fail. They charge origination fees to borrowers, servicing fees to investors, and sometimes additional withdrawal or management fees. While each fee may appear small in isolation, over time they significantly reduce net returns. Unlike traditional bonds or index funds where costs are transparent and minimal, P2P lending fees are often buried in fine print and performance assumptions. Liquidity is far worse than advertised. Many investors assume they can exit P2P investments easily by selling loans on secondary markets. In reality, liquidity is often poor or non-existent, especially during economic stress when everyone wants to exit at once. Some platforms restrict withdrawals, suspend secondary markets, or require steep discounts to sell loans early. This turns a supposedly flexible investment into a locked-up position precisely when capital is needed most. Psychological trap of small wins. Early in a P2P investor's journey, returns often look strong. Interest payments arrive regularly, dashboards show steady growth, and defaults seem manageable. This creates false confidence. Investors increase allocations, reinvest aggressively, and underestimate tail risk. The problem is that losses tend to arrive later, in clusters, during downturns. By the time defaults accelerate, most of the capital is already committed and the damage is irreversible. Tax treatment makes returns even worse. P2P lending income is typically taxed as ordinary income, not capital gains. This means interest payments are taxed at higher rates than dividends or long-term equity gains in many jurisdictions. Worse, defaults are often not fully deductible or are difficult to claim properly. The result is a poor after-tax return compared to other investments with similar or even lower risk. Platform risk is rarely discussed. When you invest in P2P lending, you are not just betting on borrowers, you are betting on the platform itself. If the platform mismanages funds, changes terms, freezes accounts, or shuts down entirely, investors may face delays or permanent losses. Unlike bank deposits, P2P investments are not insured. Platform failure risk is real, and history shows that even well-known platforms can collapse or radically change investor terms. Economic downturns expose the core weakness. P2P lending performs worst during recessions, exactly when investors most need stability. As unemployment rises, borrowers default, recoveries fall, and secondary markets disappear. Meanwhile, safer assets like high-quality bonds or dividend-paying equities often recover faster. P2P investors, stuck with illiquid, deteriorating loans, are left watching years of small gains vanish in months. Diversification does not work the way investors expect. Platforms encourage investors to spread capital across hundreds or thousands of loans. While this reduces the impact of any single default, it does nothing against macro-level risk. When economic stress hits, defaults rise across all risk grades. Diversification within a flawed asset class does not eliminate the asset class's fundamental weaknesses. Opportunity cost is massive. One of the most overlooked failures of P2P lending is opportunity cost. Capital tied up in low-quality loans earning mediocre returns cannot be deployed into assets that compound over decades. Broad market index funds, quality dividend stocks, and even simple high-yield savings accounts often outperform P2P lending on a risk-adjusted basis without the stress, complexity, and platform risk. Who actually benefits from P2P lending? Biggest winners in P2P lending are not investors. They are platforms and borrowers. Platforms earn fees regardless of loan performance. Borrowers gain access to credit they could not get elsewhere. Investors, meanwhile, assume asymmetric risk with limited upside. This imbalance is built into the system and cannot be fixed with better loan selection or more diversification. Why smart money rarely touches P2P lending? Institutional investors and sophisticated capital have largely moved away from retail P2P lending or demanded terms unavailable to individuals. When professional money avoids an asset class or only participates with special protections, that is a warning sign. Retail investors are often left holding the riskiest slices with the least control. If you liked this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.